Welcome everyone to the Envirosuite Q4 Sales Update for financial year 23. Today I'm joined with our CFO, Justin Owen, and myself. We are going to structure this up today with a couple of slides just to tell the story through some graphs on the numbers. We will take question and answering at the end of the session, and there's two ways that you can ask questions. One, to raise your hand via the Zoom link. The other one is to put it into writing, and then we'll have those questions read out. I'm going to first start, though, with a bit of an explanation of who Envirosuite is for the new investors, and just to remind people of the journey. We're very much a purpose-driven company, and we believe environmental intelligence is a key to improving the well-being of people and the planet, and also to drive prosperity. We focus on 6 key sectors: aviation, mining, industrial, wastewater, and water treatment. And we have 3 product suites within that. We have our aviation group, our industrial group, and our water group. The common part that threads all of them through is that science is the core of everything that we build. We're taking environmental events and we're turning that into data. We're turning that then into information, knowledge, and decisions. And from NASA to BHP, we're an intrinsic part of an efficient, modern-day operations, enabling data to decisions. We do benefit from strong demand driven through ESG principles all around the world. And we are a truly global operation. And we operate in 3 regions: the Americas, APAC, and EMEA. Today, we won't be getting too far into the financial details, as the full year results will be presented on August the 22nd. So this is going to be primarily focused around the sales update for Q4. So from a key highlights perspective, we had a fantastic Q4, one that I'm incredibly proud of, a truly record quarter. 6.8 million in new sales, up 13% on PCP. Total ARR grew by 12% on PCP to 59.4 million. So let's get into some of those deeper parts on the key highlights. The record sales of 6.8 was made up of 3.1 million in new ARR and in project sales of 3.7 million. The total ARR, which grew at 12% on PCP, actually grew this year at 20% growth at the company level, when excluding the one-off churn event that we spoke about in Q3. So we're incredibly proud of the 20% growth on the top line through this year. EVS Aviation achieved a record, not a record, but a very strong 1.2 million in new ARR. But there's an important customer win this quarter that we do want to highlight, which was a 10-year engagement with Egyptian Airports Company, with a total contract value of 9.8 million. I'm going to get further into what that contract is made up of, but it's an incredibly exciting opportunity for us. We had the 4th sale of carbon emissions modelling, now across 13 sites, as the aviation sector absolutely is being proactive in addressing the climate impact and the greenhouse gas emission issues that it has to deal with. And we want to support our customers on that journey. EVS Industrial did have a record quarter, and that was 1.7 million of new ARR, driven by particularly strong growth in the Americas once again, as the company's relationship with BHP continued to grow. And that's based on our land, expand, and scale strategy. So 2 new sites were added during the quarter with BHP. EVS Water, and we announced this at the Wilson's Rapid Insights earlier in the year, we were successful in signing NEOM. Now, for those of you who don't know who NEOM is. There's a link in the release. But NEOM is an incredibly high-profile city in Saudi Arabia with a $500 billion investment going through. The engagement is, though, for 2 of its existing desalination plants. But this is going to be a long-term partner for us as NEOM starts to grow through. There's an annualized churn of 8.1%, which included that one-off event. If you exclude that, our churn is down at 1.9% for Q4. So if we spend time on aviation, let's get into a little bit more detail on this. So total ARR is now at 36.4 million, which is up 7% on PCP. Adding that 1.2 million you can see on the left-hand side of the table. That, though, is 19% growth, excluding that one-off event. Now, if you look at the history now of the aviation segment within Envirosuite over the last 3 years, this is an incredibly strong year. And what is encouraging is we're getting growth in all 3 regions. Certainly, we've had strong in the second half of this year. We've seen strong growth in EMEA, which is Europe, the Middle East, and Africa. But we've also had strong contribution from the Americas and also from APAC. In this particular quarter, we added sites in Americas, which is Ontario, Portland, and Naples. And here in the APAC region, we added Christchurch. We also, in the Middle East, we added Abu Dhabi, so 2 airports there. I want to spend a little bit of time, though, on the flagship win, which is EAC, Egyptian Airports Company. I was actually in Cairo with the customers in June, and it was fantastic to see the way that Egypt is addressing and being proactive in addressing environmental impacts. COP27 was held in Egypt. COP28 is moving to Dubai. And as part of the COP27 initiatives, they are being proactive in the way that they want to drive improvements at all levels. This is the first time that we have added Noise Desk, carbon emissions modelling, and Omnis solution into one new airport site. And so that's addressing air quality, noise, and carbon. They're seen now, certainly as the leaders in this region, and arguably the world, as to what they're trying to do in addressing their impact and understanding how this addresses the community and their operations. So we're excited to work with EAC. The other part of this, which is important, is it represents a 10-year engagement. One of the strong parts of our aviation business model is our long-term contracts that we have with customers, and we see this as a true partnership. On the left-hand side, you'll see that new ARR. It's not a linear part, and this is going to be based on, sometimes having large project wins, which you will see. But what is encouraging is our aviation total ARR now is up at 36.4, a really strong finish to the year. Moving to industrial. So strong quarter for total sales, 2.1 million. New ARR of 1.7, which I said earlier, which represents growth of 19% on PCP. But there was really strong continued growth in the mining sector. What we've seen in FY23 is continued growth in the industrial part within mining. And this is based on a certain need from the customer, but a really strong value proposition. As we've highlighted earlier and throughout the year, adding noise and vibration into the Omnis platform has significantly expanded our reach and the benefit that we provide to our customers. And certainly with BHP now, we're well positioned to support them for a long period of time. And if you think about the mining sector, similarly to airports, mines operate for 40, 50, 60 years. And so we see this as a very strong business model, but a very sticky business model as well. The Americas contributed 52% of new ARR. And what we are seeing is that it's not just mining within the Americas. So environmental justice is certainly driving awareness and driving investment from our customers. We also were able to add a significant customer in the waste sector. And we will see that in the FY24 growth, that waste will continue to play a key part in our growth. What I'm particularly excited about, though, is the emerging blueprint for cross-selling EVS industrial into EVS aviation, as air quality becomes a stronger need to address in the marketplace. Whilst we can't name the mine site with BHP, it is a large copper facility, copper mine in Chile. And so this is helping them address their environmental risks and identifying when those risks develop and when those risks are expected. And this comes back to the strength of our platform being strong in a predictive capability. We're able to work with them in a proactive sense. So the platform is helping them think ahead of time. And this is driving a strong operational improvement. Again, another key part of our strategy that we set 2 years ago is land, expand, and scale. We've spent time with our customers. We understand what the product can do. It's also fed then into new product ideation and making sure that we have a truly scalable, repeatable, and efficient platform to help our customers. Moving into water, as we said, we added 0.2 million for Optimizer and Designer. So this is looking at desalination plants where we are looking to reduce the energy required to produce drinking water, as well as the chemicals that go into the process. This provides a strong return on investment. If you now look at the footprint of our desalination plants, we're strong in Hong Kong, in Singapore, and now in the Middle East. And what we have seen on the back of this announcement with NEOM is a strong interest across the board. Our global lead for water, Sada, joined around 5-6 months ago. And Sada has been working proactively with key customers around the world, both at an asset level within the likes of NEOM, as well as in the industrial and partnership opportunities. And through the coming quarters, we'll start to see some benefits of the investment that we've made within Sada in that space. The other part, though, to think about is what we have already done with our customers with Watercorp, and we continue to work with Watercorp, SA Water, SEAP, DAM, Kalamazoo, and Evoqua to work through how SUEX plays a pivotal role in them addressing their operations and their risk moving forward. SUEX has seen significant advancement at a technology level this year, and we're proud in how we've been able to validate the technology and help our customers achieve their goals. I would encourage all listeners today to go onto the link on the bottom of page 5 to have a look at NEOM and what NEOM is wanting to do. By us positioning on the first 2 desalination plants and building that out, we are very well positioned to support the significant investment that NEOM will have over the coming years. But importantly, we don't have to wait for these desalination plants to be built. They're operational today. Finishing up here on project sales, you'll see that graph is a very nice graph where it goes up for the last 3 quarters, finishing with a very strong 3.7. Now that is helped somewhat by the large aviation project wins that we had in Q4. And you will also see that this is not necessarily a linear path, so this will be lumpy as we move forward. What we have now seen over the last 2 to 3 years is that project sales are stronger in the second half of the year. At the moment, we don't anticipate that changing, but just to give you that insight. The other part there of project sales is that it does drive an expansion opportunity. And so project sales we see, and been the case over the last few years, is how that supports the ARR business model. The other part of project sales, why it's important for our business, and I'll pass to Justin in a minute to cover off some of the financial observations of the quarter, is that it does lead then into cash and profit in a relatively short space of time. I'll finish with the outlook. So look, we do reaffirm our position about transitioning to adjusted EBITDA, but we're not going to spend a lot of time on this today because the results will come out in around a month's time. But we did end the year with another record sales event. And we're really proud of how we finished the year on Q4. But we also enter now FY24 with really strong momentum. Each quarter, we're seeing a stronger lead generation through our marketing platforms. And we have got a strong pipeline within our current key accounts, so through our land, expand, and scale. And we're very targeted in those 6 sectors that we've spoke about at the start of the presentation about how we want to drive growth. So we do see strong upward momentum. But also, the other part of that is being a product-led organisation. We have strong product portfolios, and we've invested into that technology leadership. A lot of those wins that we had this year were actually in competitive situations, which is great to do. But we also were able to be successful in just engaging with the customer directly to help them and take them on a journey. They trust us, and we want to be there as a long-term partner. Our 3 regions now have a mature sales, operations, and leadership team, and we'll continue to see growth in all 3 sectors. So, Justin, I might pass to you now just to close off on the finances.
Thanks, Jason, and good morning. As Jason mentioned earlier, we will be providing further visibility on our results and outlook when we release FY23 later in the year. But again, confirming the transition to adjusted EBITDA profitability, and what we will see is a significant improvement over our FY22 comparative, being a loss of 4 million. In terms of the year, we finished with cash above 8 million, which is in line with expectations. So pleased on that piece. In terms of churn, we mentioned our churn number of 8.1%, including the significant event, and 1.9% on an excluded basis. When we dig a little bit deeper into our reasoning for churn, a couple of the key points that come out on a relatively small population, I should say. Firstly, it's budget constraints in some of our customers, where there was no alternative provider sought, so provides an opportunity for us down the track. In another, there was a completion of initial phase of a contract with a potential for future, but nothing signed up at this point. And a last one was a change in management and their priorities. So in none of the churn events that we identified or we had reported, there any transition to another provider. So we're very comfortable in those ones, as well as providing an opportunity for us down the track. As Jason said, moving to project sales, they are a combination of implementation and instrumentation for some of the major projects in the period. Certainly, Egypt Air is a significant one for us, as is Abu Dhabi, where again these project sales and ultimately shorter term revenue opportunity will lead to the longer term recurring revenue growth. Of course, there are on the project sales some instrumentation replacement and expansion programs that are operating within our existing customer base that won't have a direct impact on ARR going forward. Lastly, just want to finish off in our implementation activities. They remain well managed with a very deep understanding of occurrences within the supply chain. We mentioned at the half year that our supply chain has recovered from the pre-pandemic, and we're able to manage those those supply relationships very positively. More importantly, we have a very strong team leading our implementation process, and we're confident that implementation timeframes will continue to improve as we move forward. That's the highlight, if you like, from the finance piece. Clearly, there'll be more that we will cover in our next update. What I would like to do is I'll hand to Jason, myself, back to the presentation team and open up for questions.
Thanks, Justin and Jason. Just a reminder, if you have a question, you can type it into the Q&A panel or raise your hand, and I will unmute you and allow you to talk. Chris Savage from Bell Potter, you should be unmuted now, and go ahead with your question.
Thanks. You hear me okay?
You can.
Yep.
Great. G'day, Jason. G'day, Justin. Just firstly, was Q4 on budget? Was it ahead of budget in terms of new ARR and total ARR?
We think it was slightly ahead of budget. Certainly a strong quarter there with some significant wins being, in the aviation and industrial. Some of those, though, were slightly delayed through the year, just through the procurement part. But, if you look at it from a full year, slightly ahead of budget.
Was there anything that slipped potentially into Q1?
Not in this quarter. No, we closed everything that we did want to close in this quarter.
And just the pipeline for 24 across the three sectors, if you can.
Yeah, what we have seen, let's start with the smallest one in water. Obviously, with the validation that we've now got with our customers in the three regions, and also the three product sets, we have seen a strong pipeline build up over time. I understand from some shareholders that they want to see the water go much faster, but I think we have to be realistic with understanding that this is a water utilities that we're dealing with, and it is important to understand that this is drinking water, and so we want to be making sure that we're working with our customers, not pushing that through. But Chris, very excited about the water pipeline opportunity, and that's with a mixture of different customer segments. Industrial, I was reviewing the pipeline as we always do, but really strong in mining and in waste and in industrial. And we know that we've got a strong value prop there that we will continue to build through. What we have also seen is, through the last probably 18 months, is the transition into, say, a new improved sales team, and they're functioning at a higher level there. So certainly our sales efficiency within the industrial part has improved. And aviation, look, on the back of carbon emissions coming in with what we're doing with the AEST in North America, we are seeing certainly a shift into the greenhouse gas impact. And so the pipeline and the value prop is certainly evolving in aviation. And as the market leader, we're really well positioned to pick up strong market share as we move forward.
And just back on water, Jason, what's going on with Water Corp? That seems to have stalled a bit. Is that a fair comment?
No, the opposite of that. I think it's a great outcome of how we're working with Water Corp and proving that out. I've spent multiple sessions with them myself in Perth and the water team. Really strong validation that they are really pushing SUEX to what it can do and bringing it into their organisation. So we're very happy with how Water Corp are using the software product and how they're applying it into their business. So we're happy, Chris.
All right. Thanks very much.
Thanks, Chris. We might just go to a written question before we hand over to the next person that's going to ask live. It's about project sales. Jason, could you just provide a bit of colour around project sales, how it's charged to the clients, and whether it's on a cost plus basis?
Yeah, absolutely. So the project sales are has a strong contribution margin and a strong gross margin of contribution to the business. So yes.
Well, there's a combination where we have instrumentation sales. So it could be instrumentation sales in both the aviation sector and also in industrials. So in industrial is obviously a slightly different product, and one that we are open to third-party suppliers and agreements that we've got in place there, as opposed to the aviation, which is essentially our designed and contract manufactured product. There's also an element of people cost on project sales with or project revenue when it comes to people costs associated with implementations. So there's a mix across that, but we're seeing right at the moment with the strength around Abu Dhabi, Egypt Air on the aviation side, we're seeing that combined of instrumentation sales as the lead indicator to the future ARR. And as mentioned earlier, there are a couple of one-off projects where we are replacing the noise monitoring terminals in a couple of instances, and also expanding within an existing environment with additional monitors. Again, that's across the industrial space.
Thanks, Justin. We'll go to Ross Barrows now. Ross, if you would like to unmute yourself and pose your question.
That's great. Can you hear me okay?
Yes.
Yep, all good, Ross.
Yeah, great. Just a question around the ARR growth over the year. It was around $6 million of absolute ARR that was added, about 6.5 this year. If we look back a year before that, it was also around that $6.5 million level. Is it fair to say that you'd be hoping to, get incrementally higher ARR growth in dollar terms going forward, or do you think that it could be similar year on year? I'm assuming it's going to start to accelerate with the pipeline that you've got, but maybe some color around that would be helpful.
Yeah, Ross, if you look at that, the actual ARR growth is higher than 6 as far as results, right? So we've done 2.1, 2, 2, and 3.1 in the 4 quarters leading up to this. So that's around 9.2 of ARR growth. What dragged that down was let's call it a single event churn in Q3. And so I think that's a really strong part. What we are seeing is certainly, a stronger lead into FY24, but yeah, certainly much higher than 6 moving forward. Justin?
Yeah, no, Ross, the piece to point out when you're looking at the comparison is at FY24 when we were at 53 mil, that included that major churn event. So we're calling it out because it is so significant in its impact on the financial result, and doesn't truly reflect the effort and the success that the company's enjoyed in growing ARR over the 12-month period. Clearly, all the other churn events are in there, but again, the severity and the significance of it, it's worth doing it on a normalized position in terms of what the sales team's been able to achieve.
That's fair. Allowing for the churn, that does make sense. The other question I had was just around the project sales, where it is a leading indicator over time, and hopefully that's going to continue going forward. The question I had was, is there any kind of rule of thumb, and it's probably a difficult one to answer, but is there $1 million of project sales turns into X million of ARR, or is there any way you can think about it? Obviously, every project's unique and different, so maybe there's no way to answer it, but any color you can around that?
There isn't, Ross, and it sort of depends on aviation, and industrial. But unfortunately, there is no rule of thumb. But we see it as more of part of the business model, being able to turn the project sales to revenue and to profit in a relatively short space of time, and a long-term sticky business model.
Okay, thanks.
Thanks, Ross. We'll go back to the Q&A board. There's been a couple of questions, Jason, about the competitive landscape, saying you mentioned competitive wins. Who are the competitors? And a question from John McBain about also the competitors, and were there any competitive losses during the quarter?
So who are the competitors? The competitors let's focus on water. There isn't a competitor product to SUEX. It is unique in the world, and so we call that in that demand generation space. In Optimizer, there are competitors, but no one that does deterministic modeling and artificial intelligence in the same platform. So that is unique, and we use that as a competitive advantage. Industrial, I would argue we're 3 or 4 years ahead of any single competitor in its predictive capability. So what we see in that part is more of your competition against sensors, so instrumentation, just going into a simple cloud platform. But if anyone wants to drive operational improvement, we really are, through 3 or 4 years ahead in that part. Aviation is slightly different into the standard noise solution. There are competitors both in North America and in Europe. Having said that, we have been highly successful through that quarter. I can't think off the top of my head of any competitive losses in Q4. But I can't comment on that one off the top of my head.
Okay, a couple of questions just on. I know we made a comment about profitability, but could you talk to closing cash and cash burn during the quarter? And also, does that figure of the closing cash include the Egyptian one-off upfront payment?
Okay, so thank you for the question. Of course, when it comes to profitability and more deeper financial metrics, we'll provide an update, or we'll provide insight on these when we get to our full year results. But in terms of the cash, when we advise that it's we closed at over 8 million in the quarter, which was in line with expectations. In relation to Egypt, that it's announced today as a sale, not yet as revenue. So we anticipate, having mobilised the team, we anticipate that the project revenue, so the instrumentation sales and implementation, will be hitting revenue and ultimately cash during the latter part of H1. Those immediate implementation timeframes are yet to be locked into play, but certainly the team are mobilising for that rollout. In terms of profitability, in terms of cash and cash burn, it's something that we focus on quite significantly as the executive team, and certainly at the operating cash flow level, we're starting to see some good turnaround in those numbers. What we have got is an increasing position that our customers are wanting to take certainly in the industrial space, where they're wanting to transition from a upfront acquisition of instrumentation to one where the instrumentation is packaged up and rolled up with the software access piece. So they're wanting to convert what we term a CapEx sale into OpEx. So we are seeing a increasing pressure, if you like, from the sales organisation on how they wanted to deliver to their customers in the industrial space, and we want to accommodate that. And so we are investigating options on how we best fund that going into the future.
Thanks, Justin. Just mindful of time, I think we'll take one more spoken question. We'll go to Andrew Page. Andrew, if you can unmute yourself and pose your question.
Yeah, thanks for that. I'm obviously a lot of talk of inflation lately. I'm curious as to what pressures you've felt directly with your costs, whether that be sort of staff or instrumentation, but also perhaps more interestingly, what ability you have to pass on costs. There's fairly low churn. You're pretty tightly embedded into customer workflows. Is that a lever that you have pulled or can pull, and to what extent that might be achieved?
Yeah, thanks, Andrew. Good question. So look, being a software company, our biggest costs are going to be people and the cloud infrastructure to support it. So we do manage that tightly. We haven't grown anywhere near the space, from a headcount perspective that other technology companies have done over the last 2 years. So we've really controlled that headcount number, and thereby controlling the cost of the business as we move through to that cash flow positive target that we have. From supply chain and instrumentation, we do manage that incredibly tightly through good, strong partnerships in the industrial sector, and also our own supply chain within the aviation part. So that is an area that we do focus on, and utilisation of cash is strong. So yeah, we're happy to date of how we have been able to manage that. Going back to the ability to flex that with the customer, where we can, we do within the contract construct. And so in large parts of the aviation and in industrial part, we do have CPI as a trigger point in those contracts. And so we do within contract terms, obviously, and we want to look after our customers and understand that journey, but we do have that ability to do that.
Thank you.
Thanks very much, Andrew. And Jason, I might just, I'll quickly say we're always very happy to take questions. Please submit any questions at any time to investors@envirosuite.com, and we'll come back to you. John has posed a very specific client question, which I'm not sure we are at liberty to talk publicly about. So John, I'll investigate that and look to come back to you with an answer there. But Jason, perhaps just some concluding comments from yourself.
Yeah, look, really happy with the quarter, but more importantly, happy with the year. So first of all, to our staff around the world, to the Envirosuite staff, a fantastic year. I know people have worked incredibly hard to get the result and to really focus in on our customers. So first of all, thank you to the Envirosuite. For our customers, the partnerships that we've built and the trust that we've built, we'll continue to invest into that and to make sure that we are seen as a leading environmental intelligence technology company in the world, which we are. And certainly the outlook for FY24, I think, is exceptionally strong for us. We're well positioned from the technology and the product perspective, from the go-to-market motion that we have in each of the products. So we really are well positioned for a strong FY24. And so to the new shareholders that have come on, thank you. Thank you for supporting, and also for the existing shareholders that have supported us for a long time. I think the transformation that we have made in the company that you would have seen over many years now, I think we continue to improve each part. So I think Q4 caps off a great FY23, but importantly positions us for a really strong FY24. So yeah, thank you to everyone for joining today.